This meeting is being live streamed. That means it's value after hours. I'm Tobias Carlisle, joined as always by my co-host Jake Taylor. Our special guest today is Michael Guyad. He's the publisher of the Lead Lag Report, the promoter of the lumber gold ratio, which I think is a really interesting one. We're going to talk about that a little bit. How are you, Michael? You're muted.
I'm such a good promoter. I mute myself is what it is. Yeah, promoter is a funny word in this.
Promulgator?
Yeah, probably right.
Yeah,
You
I
know,
should have been. That's the wrong word. Sorry about that.
no. You know what's funny is like people will say like if you're self promoting that you're a grifter,
Yeah,
right? It's like you
yeah,
see that
yeah,
on
yeah.
social media, and it's like really, guys. It's like if you're trying to run a business, if you don't promote yourself, who's going to promote for you? If you don't promote your
100%.
research, who's going to promote for you? Like how do you grow a business otherwise? Yeah. Anyway, more of a side, but I appreciate the invite.
Yeah, my
Great having
pleasure.
you on.
I've known you for a little while, like through social media. I don't know if we've chatted a few times in podcasts like this, but not outside of that. So I was just sort of interested to know you're just where the setup is S&P 500 and the Qs are the best performed asset class in the world. You can get them for 9 basis points. Why would you do anything else?
It's hard to argue with that.
Checkmate.
Yeah, no. Okay, so
Thanks for coming, everybody.
yeah,
Yeah.
this has been a great podcast. Actually, no, look. Okay, so first of all, let's be very clear about something. Um, every strategy has times when it works, times when it doesn't. Every strategy has cycles where it works, cycles where it doesn't. Every strategy is also a back test, right? Like buy and hold is a back test. It's a back test with one trade, sure, still a back test, right? And I say that because people always criticize strategies that use some form of back testing. Meanwhile, they'll believe in passive, which is just a complete inconsistency, logically speaking. Okay. So you're in this cycle here where really since QE3, September 10 or 11 of 2012, I know that date is seared in my mind because that's when I launched my mutual fund. When I launched my mutual fund, literally the day of QE3. Ever since then, it's been a cycle where it's been purely about passive, large cap, S&P 500, Qs, NASDAQ, and anything and everything else lags, right? You've had plenty of cycles like that, not as long as this one, but there have been plenty of times where you see that type of behavior, right? This has been a prolonged period where it's been a game of just passive S&P, just NASDAQ, but I still believe in cycles. I also believe that when something becomes the only game in town, it's game over. Because at some point, it becomes a crowded trade. At some point, there's some kind of dislocation. And, it's like if everybody's on the same side of the boat holding an anvil, you want to get out of that boat, right? I think we're at that stage, or actually pretty close to it, at least, when you look at household allocations to equities. And when you look at those stats, it's the S&P, it's Vanguard, market cap weighted, right? When you look at sentiment surveys, you look at positioning, you look at short interest. I mean, everything basically says we're in a passive bubble of sorts. So to say that just because you can get a bubble cheap and the bubble's worth means you should just ignore everything else, to me, that's a mistake.
I tend to agree with that uh, beginning that date as the beginning of that cycle because I publish this little chart all the time, just taking fama French price ratios, and you can take your pick, but price to cash flow I think is the one I like to use price to cash flow because everybody's got a criticism of price to book for the obvious reasons, price to earnings, whatever. So price to cash flow seems to be everybody sort of agrees that that one's acceptable. And then I use the market capitalization weighted, so it's not a small company phenomenon. It's just I'm trying to find every reason that I can why you'd argue against this chart. And what it shows is that the data starts in like 1963 or something like that, and it runs in that the decile 10, which is the cheapest, what they regard as the value decile, versus decile 1, which is the most expensive, glamour, whatever you want to call it. There's this very marked outperformance for the value strategies until 2010 to 2015, somewhere in there, depending on which strategy you
Yeah.
choose.
Yeah.
Then there's this massive drawdown, like nothing we've seen in that data running back to 1963. And that drawdown has run basically until, it bottomed in 2020. And then it did seem like there was a bounce coming down sort of 72% on a relative basis
Yep.
to the most expensive one. It bounced a little bit, but now we're back to where we were at the biggest part of the drawdown. So either that is fundamentally broken and can't recover. I don't believe that, but I have to acknowledge that that's a possibility. Or there's this sort of great performance coming in front of us, and I don't know which one it is, but I'm sort of interested to hear why it's not broken. I mean, feel free to
No,
feel free to.
no, that's good actually. So let's play with this. The
Confirm my priors, please.
Yeah, that's what I'm saying.
right. Misery loves company, especially in podcasts. Okay, let's play with that. Let's talk through the fundamentally broken argument. Okay. Broadly speaking, why is it that growth has outperformed value? Why is it that U.S. has outperformed international? Why is it that large has outperformed small? The answer is the same across all three. It's tech.
Yeah,
It's not a factor dynamic; it's a sector dynamic, right?
yeah,
Large cap is dominated by tech companies. Small caps are not. U.S. is tech dominant. International is not. Growth is tech. Value is not. Value is financials, right? Industrials. Okay. So the question, so the argument that it's fundamentally broken is what? That we're in an era where tech is everything, right? That this is the world that we're in. That the exponential nature of technology makes it impossible for other companies to possibly catch up, and it's beyond winner take all within tech. It's winner take all across the entire system. Okay, I think there is actually a legitimate argument for that,
yeah,
right? Which scares the ever living crap out of me,
yeah.
Yeah.
right? Because what's the implication of that? Then what are we
Well,
doing?
Mark Andreessen says software eats the world, and like Mark Andreessen seems to be right so far.
Yeah, well, right. Okay, now that's the other side of it. The other side of it is so far. If it's not fundamentally broken, then it's a cycle. Okay, so if it's a cycle, what becomes the catalyst for the cycle to break? Right? Because that's you need something, right? Time doesn't seem to be enough because it's already been a long time. Okay. And we don't know what that would be, right? But I would submit to you that the only way you get that big catch up is if you shake the money that's playing the momentum in tech. And if you shake that momentum in tech on a sustained basis, then that money will eventually rotate international into value into small.
Well,
But you've got to break tech.
traditionally it's been a crash, right, that has sort of created that transition. And 2020 looked like a crash, but in retrospect, it was probably more like a flash crash. It was more,
Yeah, I agree. Yeah. Yeah.
it didn't really cause anybody to change anything. And if anything, what it showed was that you really needed more tech because tech was the thing that bounced hardest out of the bottom. That,
Right.
what do you think about Michael Green's thesis that it's basically flows from passive that have just gone to the winners, and so the winners just keep on winning. The biggest market capitalizations attract the bulk of the flows,
Yep.
and
I mean,
so therefore it doesn't turn around.
yeah, I mean, I've called that structural insanity, right? Because it's structural, and because literally that's the default option is to go into equities, which are basically market cap weighted vehicles and 401ks. So you have this auto bid, which is basically the Michael Green argument around passive. And it's structural because it's the default option. People are not even realizing it. They're putting a portion of their income automatically into basically the largest companies, right? In terms of the allocations. And again, it's worked, but it also creates distortions. So take it to the logical conclusion. If we're in a world where everything is broken and it's purely passive, okay, the true value of anything that's active is what? That it's fundamentally rewarding companies that are doing the right thing, right? In terms of profitability, in terms of earnings, in terms of everything. Okay. Market prices are a signal to a company that they're doing something right or wrong, also. If you don't, and you need active management for that to play out, for that signal to mean something. If everything has gone passive, then there's no signal for individual companies, which means that companies end up floating to the top, maybe not because they're actually good companies, but just because of their relative weighted position in an index, everybody's buying automatically. Right? Take that to the further logical conclusion. We've seen this incredible concentration keep on building. I had looked at the NASDAQ 100 in 2010. The top 10 holdings were, I think, 49%. Now they're 60. Okay. I think maybe even be more than that. So like, all right. So then at what point does the passive auto bid, which is causing more and more of that concentration risk at the top, at what point then is it not a market anymore? Right? At what point is it are these tech companies now the too big to fail dynamic? Which means that anytime you have a market crash, the Fed is not stepping in to save the economy; they're stepping in to save 5 companies or 6 companies or 7, whatever it is, right? Because it's such an outsized contributor to total return. I find that to be very disturbing. I really do. I spent my youth studying markets, reading old books on markets, and really getting into the sort of historical tomes, right, on fundamental analysis, on technical analysis. This is not the way investing is supposed to be, but it's the way that people think it is.
I think that's Michael Green's thesis is basically that the continued drip from passive ultimately turns into a crack up boom, which is followed by a crack up crap, followed by a crash. And the idea is that as active leaves the market and passive becomes the
Right.
marginal bid, it's only active selling because passive has no reason to sell. Active has some sort of presumably valuation or some other reason for selling. I still think that that creates an opportunity on the other side where there there must be better companies that aren't being valued just by virtue of the fact that they're small. And so there should be sort of arbitrageable profits there that aren't being arbitraged. So surely value and other sort of fundamental strategies are able to pick those up and profit, but it doesn't seem to be reflected in the returns so far anyway.
Well, okay, now, but okay, so for it to be arbitrageable, you need to have players in the game who care to arbitrage, right? And I think this is another sort of interesting dynamic about the cycle that we're in. Other than the GameStop saga, which you can argue was a community of people that were wildly into all the nuances about the company and the short interest and all this stuff. For the most part, why should money think about undervalued opportunities when they can YOLO into a 2x single stock that is up 100% in 3-4 months?
Well, that's true, right? It's not only GameStop, it's AMC. I mean, Tesla is the original meme stock, probably.
Yeah, and you've never had a cycle where you've had so many different ways of playing a very aggressive position, right?
Right.
With either leverage or option, whatever it is, like and the ease of access of all of that, right? We've never had that ever, right? Structurally.
Yeah, you could lever up sitting on the toilet now. And when it was
Yeah.
quite a bit harder to do that before when you had to call your broker and go
Well,
on margin and
you can buy
You can buy fart coin while you're on the toilet, right? I mean,
you can buy
ironic.
Bitcoin directly. You can get MicroStrategy leverage on the Bitcoin, and then you can get two by MicroStrategy. I think that's the limit so far, but two by MicroStrategy, or you can play it with options as well.
Right.
And all of that just seems to be it's this virtuous circle and it only goes in one direction. I think that probably that breaks down at some point, but I thought it would have broken down a lot sooner than it
No,
already
look,
has.
I agree with you 100%, and this is something I'm battling myself now because I look, I've been wrong about my assessment around a credit event when I was very loud about it in 2023, right? And I was wrong about it with hindsight because I never thought that on the one hand the Fed would be hiking rates at the same time Yellen's injecting liquidity, which is why credit spreads kept on tightening. I mean, the insanity of it is that that's why we still have inflation. The Treasury never allowed the Fed to fully drain the liquidity out because they kept on putting it in instead, right? So I'm fighting with this argument that I'm some perma bear, and I keep stressing I'm not. I've been in the content game for 15 years. You can't be a perma bear and be in the content game for 15 years. Okay, what I tell people is that it's not that I'm bearish on stocks; it's that I'm bullish on a tail event. I believe that all of these things that we're seeing are precursors, they're conditions that result in an accident. I don't know when, right? Like I've been screaming about the reverse carry trade since, October of 2023 as being a risk, right? Suddenly it happens for 2 days in August of 2024. I didn't think it was going to happen suddenly in August 2024. I didn't think it would last just 2 days.
it was over before it began.
I mean, like, and that day was crazy. I had 15 million organic impressions on X. 15 million impressions that single day. Everyone's high fiving me. And I myself said, I bet you what, they're going to rally it now because everyone now suddenly is a bearish expert on the yen carry trade, right? I still think that's a risk, but it's like you can be bullish on a tail event, but in this environment where you have a lot of players who have, you can argue, maybe unjustified by skill, justified by luck, success, by YOLOing in these levered products, that causes them to think they are smarter than the person that is trying to do something more thoughtful in a cycle that doesn't favor thoughtfulness. It's maddening.
Yeah, it's been a long cycle like that. I think I thought 2020 was kind of the break, but then it rallied after that. So then maybe 22, and I thought that there was pretty good evidence for some sort of recession around 22, 23. There's no the NBER didn't declare it, so it didn't happen officially. But if you can look at across any number of metrics, there's this pretty clear dip that year that did turn around and ultimately, which is what all recessions ultimately do. And then I think the stock market followed it. It just said it wasn't ever declared by the NBER, but
Yeah.
I think it happened, honestly.
I mean, the $1 trillion deficit can kick the can down the
Yeah,
road, can it? Right?
Yeah. Well, which goes back to the why I find the environment disturbing. It's just it's distorting market signals. It's distorting, actually distorts efficiency, right? I mean, in terms of, it's like where is capital best treated? It should be to the companies where fundamentally they're strong and solid. And so I've used that line many times before, and I've been wrong because the market, the S&P, not the market, has kept on doing what it's doing. I keep saying, when a rising tide does not lift all boats, everybody drowns. So, in the same way we have two Americas, in the same way we have the very rich and everybody else, the stock market has become the parallel of everything else around us, where you have basically the Pareto principle on steroids, right? And it's just
Pareto squared.
yeah, and then it's like, all right, well, what's the implication of that? The implication of that is a very uneven environment. It's beyond just haves and have-nots. It eats at the core of, through which people interact with each other, right? And it creates this gambling mindset, which is why you ask anybody on the street, "Hey, do you have DraftKings on your phone?" I can almost guarantee you, almost everybody has DraftKings on their phone. They're doing parlays. They do this. So, I like this. Everything post COVID has resulted in something really fascinating culturally, in that it's become this environment where people just say, you know what, the hell with everything. I'm going to just gamble. And gambling is now available in any which way you want, whether it's at the actual physical casino or sitting on the toilet on your phone buying Farcoin. Okay.
Yeah, does feel a bit of a kind of financial nihilism that probably has set in and created some interesting societal impacts.
There's definitely a
I'm
gener
actually quite disturbed by it, to be honest. Like I think it's not a good thing for your civilization to be
I,
too anchored to gambling.
no, well, I mean, it's bread and circuses, right? Because it's like everybody's just getting the dopamine hit from gambling. Um, you really think you can have democracy working if people are just not thinking, they just want the dopamine hit? And then by the way, it's like that's the other thing. As you get these dopamine hits, at some point your body acclimates to it, which means you need even bigger hits, and it creates people taking on more drugs, taking on more alcohol, taking
Yeah.
on bigger bets, and it's like, guys, you really want to encourage this?
I think that the nihilism is not, it's understandable in the sense it's so hard to get on, real estate relative to incomes is as stretched as it's ever been. Mortgage payments relative to incomes
Yeah.
is as stretched as it's ever been. So people
Student loan
buy,
debt.
yeah, so people buy expensive cars and gamble as a way of feeling better because the expensive car's within reach, whereas the house is not. And you can gamble and maybe you hit it big enough that you can then go and afford the mansion.
Yeah, I mean, look, it's even culminated in our president having a meme coin, which I don't know if he claims he has or hasn't, but I mean, it's the whole thing is just very weird to me. It does feel like a simulation,
It's truly bizarre.
right?
I can't
And
believe, I don't know, is he associated with it? It just seems insane to have done that before he went in.
well, and there's some people that get it. Like when I was ranting on it nonstop on X, some of these posts I was putting, I got like 1.5 million views. I said it's an effing disgrace because this is a disgrace. Even if he's not involved, he should say I'm not involved. He should have said it that day.
Wait,
right?
does he hold? Has he been issued shares in it or whatever it is, units in it?
I don't even know. I saw something that like if he's not supposed to algorithmically sell it until 3 years later, I don't even know. I was like, this is, but it's just like, what the hell is going on here, guys? Like, whatever happened to just like, I don't know, looking at earnings reports and looking at margin? It's like this is what's happened. It's disappointing, because if you build a career on a system that no longer is, what are you supposed to do after that?
Well, I would think that the argument would be that the fundamentals, this has always been the case, right? If you go back and you read Graham from the 40s, he's saying that there's rampant speculation, we're completely detached from asset values, and there's a consequence to that where you ultimately get a crash. And so you have to find some way of proceeding that's not purely theoretical. And he says one way you can do that, valuation, ultimately, you do have rights as a shareholder to the assets and to the dividends out of the company. And so that tethers you to some fundamental that's real. And if you can get those things, then you aren't proceeding on the basis of like just something that's completely made up. You may not get the multiple expansion, but you'll at least get the flows of the underlying business, which ultimately that's what I'm trying to do here. That's what I'm in this business for. So I don't feel like it's changed that much. It's just that maybe it's on steroids. It's more, we've never had social media tell where someone can show off how much money they've made speculating on something so easily and the Lambos and whatever that they've bought with it, and then have someone able to then download immediately an app that allows them to go and trade immediately to sort of replicate the same thing. I remember the poker boom from the early 2000s. I mean, ultimately that did sort of collapse. I don't know, either it collapsed under its own weight or when it was made illegal, but I remember a guy who walked the length or the breadth of America pushing a wheelbarrow because he had lost so much money in poker, and it was his way of sort of doing penitence for losing all of that money. And we don't see those kind of or yet we haven't seen those kind of gestures by anybody who's lost a lot of money. We've only seen the other side. We're only seeing all the victories.
The meme of throwing intelligent investor into the
Yeah,
garbage though, it does
Yeah,
make
how
me
often do you
laugh.
see
That
that?
that one is pretty funny.
I see that every day.
yeah.
Daily.
And I mean, is it a meme or is it just fact? Like,
Yeah, that one might actually be. People are doing that now.
you know what and I do think this is true, that we got to a point where it's just a game of liquidity, and the policymakers have now full on admitted that they're basically bribing to get votes, right? By offering more and giving liquidity and giving checks when you don't need it, and like and really what every policymaker is playing off of is money illusion, right? So elect me, you're going to basically have more in your pocket, okay? And everybody thinks in terms of nominal, and then here comes real. People don't vote based
You
on
do
real;
have more.
they voted based on nominal, right?
Yeah.
And
There's,
we,
Are you saying you can't print goods and services for everybody?
well, with 3D printing, apparently you can. I don't know, but
but
it's just
but
Yeah.
but are they really? Like, do you think? I think some of that, there are a lot of articles, almost like it was a coordinated effort to say, what you're seeing. Why don't you believe what the economists are telling you about? Like, there's a Greg Ip article today in the Wall Street Journal that says you're wrong about the economy.
hmm.
Why are you so wrong? Why won't you believe what the economists are telling you? And then the comments underneath are pretty great. Like it was Rudy Havenstein tweeted it out. And the comments underneath are like, why does this feel like a coordinated effort to tell us that we're all wrong? Like, I think probably the last election was largely or partially,
Yeah,
inflation.
remediation. Yeah.
Of course. Did they
So
just
it's,
show pictures of eggs as a reply?
so someone made a whole post using eggs, like egghead economists don't understand that the price has gone from $2 to $4 and then $4 to 13 cents. Like, it's still $2 to $4.13.
Right.
We don't care about the fact that the last 13 cents means that inflation is falling because it's a rate of change rather than a level.
Right.
Right.
You never get back the cumulative purchasing power
Yeah,
lost, right?
Yeah, and also the problem with all these economic data points is they're aggregate numbers.
right.
And it's like you can't really aggregate things when the disparity between the 1% and everybody else is only getting wider, when the disparity between large caps and small caps is only getting wider, when the disparity between US and international, like all the things we talked about, right? So it's like you can drown in a pool that's on average 6 feet deep.
Right.
Like,
Mhm.
so what that an average number is good? It doesn't mean that people are doing better.
Let me give a quick shout out to the folks playing at home. Santo Domingo, Dominican Republic, what's up? Gothenburg, Sweden, Boise, Idaho, Guatemala, York, UK, Roseville, California, Bangalore, India, Mendocino, Dead Cat Gully, New South Wales, me too. Tomball, Texas, Bucharest, is that Romania? Tampa, Florida. William the Wizard of Waterloo is in the house in London, another London, Toronto, Tallahassee, Seattle. Jupiter, Florida, you've already won, Sam. Moncton, Canada. Dubai, Helsinki, Finlandia, London, Lausanne, Switzerland, Valparaiso, what's up, Max? Skövde, Sweden, Petah Tikva, Israel, Haifa, Israel.
Speaking about Dubai, by the way, have you ever had Dubai chocolate?
I haven't, is it good?
No.
Zurich,
Is it
Barrow and
melted?
Furnace, that's it.
Dubai chocolate is
Oh,
no.
is that the, I saw an ad for that, some,
That's
yeah.
that is no
What,
joke. I mean, when I break my fast, if I'm gonna like go for a sugar rush, man,
what's
that
in it?
is I don't even know. It's like
Cocaine, Toby.
yeah, basically, it's like it's I don't know. It's just really good chocolate. It's got like kanafa, pistachio cream.
Yeah.
It's like
All
it's the
right.
texture thing is kind of cool. I'll get a break.
There's a name for it that plays in the kanafa, kanafa, it's like I can't get enough.
I'm
Kanafa.
Egyptian. I don't even know. I can't tell. I'm like,
I saw an ad for it I saw a New York Times article about it, and then I clicked on the link for the bakery, and the bakery's website was just blown up
no, yeah, exactly.
by too many hits on it.
Yeah, yeah. No,
404 hit.
it's like no, it's like this is why now the Hershey drawdown makes sense.
Mm.
Hershey's stock has
Yeah.
done so terribly, and everyone's going to Dubai chocolate.
Who's
Whoever's in
that?
Dubai, send it to us, please, if you're watching. That's it.
Yeah, we'll give you a shout out on the show.
Yeah.
We're not proud.
No. Any
Was that Edwin Dorsey who?
tariff thoughts?
Yeah.
Been in the
Uh,
news.
yeah, I mean, yeah, it's like, but since you mentioned Edwin Dorsey, I'm a fan of Edwin Dorsey. I've had him on a space before. Um,
Well, he called that. He said Mr. Beast was going to take down Hershey,
oh
which
yeah,
seemed,
yeah.
which seemed risible at the time, but like appreciate now it's down so much. Good call.
Well, you know what it is. You know what's interesting about this is that, and then I'll get into the tariffs. The generally, what's the biggest expense for most companies? Marketing.
Yeah.
So if you're the influencer, you don't need to spend on marketing. Your margins are instantly higher, right? And you immediately can crush your competition if you have an influencer-driven type of company, right?
Yeah, but Buffett has written about sort of the emotional connection that people have to chocolate and the reason why it doesn't travel. You know, Hershey's is big in some places, Cadbury's big in
Right.
other places, and I don't like the taste of Hershey's because I grew up eating Cadbury, but I love the taste of Cadbury. Like, and there is some sort of emotional connection there. So
Yeah.
I thought that maybe that would be playing against, but evidently the kids don't care. They want Mr. Beast's whatever.
Yeah. Well, and the kids are all getting overweight and obese. So and
No,
that
no
makes
emotional
sense.
connection to the chocolate, I guess.
Yeah, exactly. All right, so let's talk about tariffs since you mentioned it. So I've had fun on the tariff thing, right? With Trump. Like I was on CNBC Asia the night before, and I said, people forget that the one that wins in a fight isn't the strongest; it's the craziest, right? And Trump happens to be both, right? Which is why I think it's true that you know he's like, all right, in his mind, he clearly has the mandate. In his mind, he probably just doesn't give a damn anymore because lame duck president. And candidly, I don't know if people really. I certainly can't, but it's hard to envision what's going through his mind. The number of times his life has been, on the edge, right? It's like that changes somebody's psyche and psychology permanently, right? When you face near death experiences, and now you're the most powerful person in the world. It's like he's not going to care what anybody says or thinks. He's not. He almost
That's a
died
good
many
point.
times.
I
Like,
don't think he
Yeah.
cared beforehand.
he didn't care before. He
No.
said, "Definitely not
Certainly
going to
doesn't
care
care
now."
now.
Right?
Yeah,
Financial death close often,
Yeah.
and then
yeah,
So
that's a
it's
good
like,
point.
now, and that makes him very dangerous, right? Which is why I'm saying he's the one who wins in a fight is the craziest, right? So, first of all, talk about economists. Economists would, I think, largely correctly argue that tariffs are inflationary. Okay, cool. But if tariffs are high enough, it could cause a collapse in demand, in which case, maybe oddly enough, tariffs are deflationary. We're in an upside down world, man. We
Yeah.
went through the fastest rate hike cycle in history, and credit spreads got to all-time lows. So don't tell me that you can't have a situation where tariffs are deflationary.
And then they started cutting and rates went up.
Yeah, don't
We,
tell
Yeah.
we
me. Yeah,
truly are through the looking glass.
yeah. It's like what it's again. We live in a stipulation, but it's like don't tell me something's impossible anymore. Nothing should surprise anybody.
Yeah, a lot
Yeah,
of historical correlations that you would have banked on in a lot of ways have proven a little illusory in this the last 5 to 10 years, maybe 15 years.
Yeah.
yeah, that's exactly right. So it's like so you know, and I do think that most people don't understand. Um, there's an argument to be made that because maybe this is purposeful by Trump, that he wants investors to feel the volatility of his words. Because the more volatility there is in terms of potential policy, the more at some point the market will get used to it.
Yeah.
Mm.
Like it'll just dull the reaction at some point, right? So he can actually do what he really wants to do.
Mm.
Michael, we're at the top of the hour. We usually do this. Jake has some veggies that he's got a little learnings to make benefit. Great, glorious nation of value after hours. So he's going to share some of those with us, and then we'll come back on tariffs, credit spreads, and a few other things.
Yeah, we've done a really good job of preparing for this too with the conversation, even though it was absolutely zero planning involved. But this segment is called the physics of scale, and size isn't just physics alone. It shapes also survival in biology, industry, business. And whether you're a mouse or a multinational corporation or a startup, your chances of thriving depend on how well you manage these physics of scale. And so Isaac Newton, who of course was the mind behind unraveling gravity and calculus, he also observed a simple but powerful truth. Small objects lose heat faster than large ones of the same shape. So heat escapes through the surface area, but the energy stored depends on volume. So the smaller something is, the higher its surface area to volume ratio is, so it cools more quickly. So think about like a cup of coffee, which can cool relatively fast, versus a giant pot of soup, which stays warmer for much longer. It has to do with the surface area. So this applies both also to biology and evolution. So take a mouse versus an elephant. Mice lose heat quickly and they need constant food, while elephants, because of their bulk, retain heat and they need to eat much less often. Arctic animals follow something called Bergman's rule, which is they tend to be bigger bodies they conserve heat, which is why polar bears are larger than the relatives in warmer climates. And then there's this thing called the island rule, which is on islands, small animals will often evolve to become larger due to reduced predation, while larger animals will become smaller to adapt to limited resources. So this is why we find like fossilized dwarf elephants and why island rats tend to be much bigger than their mainland relatives. And when you think about this changing environment, like when an asteroid hit and probably wiped out the dinosaurs, small mammals thrived and they had lower energy needs, faster reproduction cycles, they burrowing behavior. And even though dinosaurs were dominant for 150 million years, they couldn't adapt fast enough to these rapid climate changes. So these same physics also of scale apply in the Industrial Revolution. Thomas Newcomen built the first large efficient steam engine. It actually wasn't very efficient, but James Watt then came along and he added a separate condenser, and that dramatically improved the efficiency. And what that allowed it to do was to make a much larger engine. Therefore, the loss of energy and the efficiency, there was less loss because it was bigger and because it had greater volume to surface area, just like we were saying. And then as kind of a fun side note, Watt wasn't just an inventor, he was also a businessman. And instead of selling the engines, he and his partner, Matthew Bolton, they licensed them and taking a cut of the savings on coal. So this was like an early subscription model with recurring revenue, lest you think
Smart.
that SaaS businesses discovered some new holy grail.
Coal as a
Um,
service.
coal
Uh,
savings service.
energy as a service. Power as a
Yeah.
service.
Yeah. And so these same physics also apply to business as well. Large corporations often dominate in stable periods, but can struggle with rapid change. Of course, kind of canonical examples of Kodak, with digital photography, Blockbuster with streaming and Netflix. And small firms, just like small animals or a small cup of coffee, they burn resources more quickly because maybe they lack the purchasing power, supply chain efficiencies. And large firms are able to spread costs more efficiently, lowering their per unit expense. So think of like a neighborhood bakery buys flour at retail while a multinational buys in huge bulk quantities and then significantly cutting their cost per loaf. And it's kind of a cliche at this point, but startups innovate quickly but often fail, while large corporations survive downturns but struggle to pivot and can miss technological turns. So, I think it's kind of a little bit of a rule, I would say, that in stable environments, big corporations dominate, but in shifting environments, the small disruptors can thrive in niches. So all of which has me wondering, as we've been talking about, like why large caps have dominated over small caps over the last 15 years. Well, I would posit that perhaps it was a bit like the dinosaurs benefiting from a period of relative calm, and economic growth over that time was relatively steady, if not unspectacular. We were kind of sub 3 GDP, but pretty consistent. And wouldn't that probably favor established players? Minimal global conflicts meant fewer disruptions. Of course, big tech does exhibit those network effects that we've talked about, and seems to kind of create natural monopolies. But I would also say then that like regulatory wise, government has gotten much bigger. Large firms with a lot of resources are able to navigate these complex compliance requirements, and a small firm can't afford to have a huge regulatory, and lobbying team. And so you're going to naturally kind of favor the incumbents then, the bigger the government. And some you might even be able to argue far enough that there was regulatory capture and allowed a lot of big companies to influence policies, further entrenching their dominance. And as a result, small caps, like small mammals in the age of dinosaurs, like struggled. So now we get to sort of like get a little bit more prognosticating, but like what would we have to believe would happen to change this, and why would small caps potentially outperform over the next set of track? I think it'd be kind of interesting to see, like maybe today we're at a bit of a turning point. AI disruption might level the playing field. This DeepSeek thing that came out maybe is a little bit of a glimpse of that. Maybe you don't actually have to be a huge company to make some novel breakthroughs. Geopolitical instability, Ukraine, Middle East, of course, maybe that's shifts a little bit more to the benefit of agile players and not the big guys. Government deregulation might allow smaller firms to find their footing. We'll see how much change actually sticks from Elon's Doge after all the dust from the legal battles clears. But like I feel like that's potentially pushing in the opposite direction of what we see in the 15 years before. And then economic cycles probably favor small caps in expansionary periods, as they tend to see their revenue grow faster. And maybe we are entering into some type of a golden age. I don't know. Some people are arguing that. And then of course you just have the valuation gap. Like small caps currently trading at a significant discount compared to their large caps, which all else equal, you would want to bet on something that was cheaper than more expensive. But anyway, the final takeaway, I think there's no universal advantage to being big or small. It really depends on what's being called for by the environment.
Good one, JT. There's a I don't know if it's Hussman or somebody else has talked about there's an accounting identity where the spending of government shows up as the profit of
Kalecki.
the private sector.
Yeah.
And if you don't have that government, which is like the government running deficits and running massive deficits turns up as profits and massive profits for the private sector. And then if you go into, the Trump administration seems to be trying to reduce the size of government. And, the Treasury under Yellen moved all of the debt down to the very short term. So we've got $36 trillion of debt, and we've got 9 trillion falling due in 2025, which we have to roll in 2025, which will be a big ask, whether you can do that at the short end or whether you do that at the longer end. I don't know how they do that. That's well above my pay grade, but that sort of seems to me to be some nearer term volatility and reversing course that could have pretty serious impacts on the market.
First of all, very nicely communicated by the Jake. First of all, small caps tend to outperform large caps in bear markets, which is the irony. They tend to be down less.
Small caps tend to be down less than large caps
in bear markets. Yeah, historically, look at major bear market cycles more often than not caps. So, but that kind of makes sense because typically in bull markets, it's the what happens is that when faced with uncertainty and volatility, as you know, there's the disposition effect. So first thing that people will do when they're unclear about what happens next, which is what happens in a bear market, they sell their winners.
Mm.
Well, there aren't been that many small cap winners, right? There'll been a select number of large cap winners, which would, those would get smoked, right? Just from a behavioral perspective. What was the other question? So sorry, Judas, I apologize.
There was two parts. There was
Maybe
the
the
change in
government angle of less regulation potentially.
Oh yeah, that's right. Yeah. So okay, so I think that could be a catalyst. I agree. So to the extent that I just saw what he's Trump signed an executive order that said for every new rule you've got to get rid of 10, right, on the regulation front. Um, I'm actually a big believer that deregulation could be a catalyst for small caps to outperform on the upside, right? Because in theory, if you remove some of that regulatory expense, margins should go up, and some of these zombie companies may not no longer be zombie companies. Conceivably, we'll see.
Mm.
Right. So I do think that could be an interesting dynamic. And if he's going to do it, he's got to do it in the next 2 years because likely the midterms just flip. Right. So he's got to kind of push the mandate now. At the same time, who knows, right? Because you could have deregulation and then AI, doesn't matter because you have this exponential nature of AI, and deregulation might be positive at the margin, but it's nowhere near as positive as the compounding of how much Nvidia's gone up.
the other thing is the tariffs. I mean, I don't know how serious he is about the tariffs. He seems to be using them as a negotiating tool rather than as a revenue raising tool, but he's certainly saying that they're a revenue raising tool, and maybe that's true against China, and that might be okay because they're largely an exporter to the US
Right.
and we're an importer from China. And so getting some back might just, I don't know. I have no idea what the impact is there. But it certainly seemed to me that if you look at the earnings trajectory since 2020, large caps have done really, really well. Like that line is almost exponential. Mid caps have gone sideways and small caps have gone down. And certainly yesterday, when tariffs were live before Mexico and Canada capitulated,
For like 2 hours.
it did seem to impact the small and micros got smoked
Yeah.
yesterday
Yeah.
and didn't really recover through to the end of the day. And I just wonder if why wouldn't they be the ones that were most impacted? Like maybe the market's right about that. They will be the most impacted by tariffs if at all.
Well, it was an interesting reaction because why are small caps lagging so badly? Because of concerns around higher for longer and rolling over their own debt. Okay. So if tariffs are inflationary, then higher for longer remains in place, and a lot of these companies are not going to survive. Problem is, treasury yields fell.
Yeah.
So you had small caps saying they're worried about higher for longer rates, but rates fell on the same catalyst, right?
Yeah, the bond market and the equity market have really been not in coordination at all for a while
No,
now,
no. Which, by
which
the
is
way,
quite interesting.
no, which by the way has been my whole frustration and part of this overarching thesis when I keep saying small caps hold the key. Talk about two things which are giving different messages. Small caps are saying default risk is real. Credit spreads are saying there's no default risk.
Yeah.
Full stop. This has been my argument since a year and a half ago that one of them is wrong. You can't have two different parts of the marketplace on the same factor giving two different messages, at least not for a long time. Right?
Yeah.
One of them has to be wrong. Okay, so if small caps are wrong, they should run because it means it's not quite to this convexity potential of distressed assets, obviously, but small caps should run because you're pricing out default risk, which maybe was never there to begin with, and the market was wrong in causing small caps to lag as long as they've lagged. Okay, so that's one scenario. The other scenario is credit spreads are wrong, in which case you finally get the long-awaited credit event, which has caused people to think I'm some perma bear. No, it's like I'm not. It's the divergence that bothers me, and
I think that's
and nobody can really properly explain it to me. I hear these arguments about junk debt is higher quality now because all of the crap has gone into private credit. I don't buy that.
I mean, that it may be true that there's a lot of junk in private credit, but I also think that if you look at historically, credit spreads are not a forward indicator. They tend to be
Right.
really, really
It's like
tight.
the VIX. Yeah.
Yeah, exactly right. They're contemporaneous. They're not
Right.
lagging either. They tend to be right on the. And so you look at OAS credit spreads or something like that. they blow out as the market's going down, so they're useless as a kind of
Yeah.
prediction.
Right.
And when the market's expensive, credit spreads are tight. So it's kind of like I see that all the time too. Like why wouldn't you be short the junk and long something higher quality? Clearly it can go against you for a long time, and nothing that I
Yes.
say here is investment advice, of course. But you know, when you get the event, you get a rally out of the tends to be like the 10-year will probably rally because that's where people go for safety.
Right. Which is the flight
And
safety trade, the Phoenix, which I've been
and
following.
junk
I've
gets
been waiting
smoked.
for it. Yeah, and junk, in which case small caps are right.
Yeah. I mean, I like that. I like that thesis, of course, like because I'm a small cap guy.
Yeah.
Yeah, I get it. And also I will say that it's like that thesis is beneficial for. I mean, there's a bias here. It's beneficial for guys like us because you can't you can't really stand out against the S&P when it's the only game in town. So you need some volatility to shake money out to consider guys like us as far as the strategies that we have, right, in different ways, right? So there is a bias not to be bearish. There's a bias to stop to want to see an end to the passive large cap only momentum, which needs some kind of shock, an event. It needs some catalyst, and it's not like it's going to happen quietly.
It's conceivable it does just fall under its own weight like that. We haven't heard it for a little while, but that Hussman was a proponent of the Didier-Sornet wave, where the wave gets it gets increasingly quickly bought until you get to this point where there's like a singularity and then you get a collapse after that when it breaks down.
Yeah,
I don't know if we're seeing that now. I don't know if we've sort of seen it being bought increasingly. It's just that when I run my own strategies, like I have a mid and a large cap, and I can run that against my small and micro.
yeah,
And the small and micro, and the only difference is that one is the largest 25% of stocks, and the other is the smallest 75% of stocks. Otherwise, they're identical strategies. You can see that the mid and large has run exponentially away, like increasingly, or the other way around. The small and micro is falling increasingly rapidly, and it just seems to me that it shouldn't be doing that.
It's a wild divergence to see. And
Yeah.
it'll end at some point. It's just you know, can you wait it out? I always go back to like people show these charts and they show all these bars and they draw these trend lines and squiggles and all this stuff. And it's like, guys, you realize that every one of these bars is 24 hours if it's a daily chart. You realize all these weekly charts, these are 52 weeks for this portion of the chart. Like we get so used to drawing all these charts as ways of prognosticating, we're not realizing that we're living in this small bar.
Mm.
yeah,
So you're
and there's a
saying that
huge difference between behavioral time and chart time.
Yeah, of course. It's like not even close.
It's,
Yeah, I always used
the,
to say on the road when I was presenting at CFA chapters, we live in the small sample.
yeah, we live in the short term.
Hmm.
The long term is what you get, but you live in the short term.
Right.
What's the way forward, Michael? What's the sensible thing to
where is
do?
salvation?
Yeah, how do we how do we make it to the other side?
Fasting? I don't know. It's a good question. I don't know.
Self-abnegation. I don't mind that as a strategy.
Well, I'll tell you something because and actually I'm half joking about it, but I'm also half serious. The look, you mentioned all these, you know, anonymous accounts showing screenshots of all these hundreds of thousands or millions of dollars they're making on a single trade, and it's like, okay, first of all, I don't believe any of this stuff, but okay, let's assume it's real. That's luck. I don't give a damn what anybody says. There's a degree of luck in this industry, and probably a much larger degree than people realize. You cannot, in our business, when it comes to investing, control the outcome. We actually have very, very little control. Very, very little control. Right? Every trader has very, very little control because so much of this stuff is noise. You want proof of that? Look at any chart that shows here's what happens when you remove the 10 best days and 10 worst days.
My favorite example is to try to pick what you think is going to do the worst in a year
Yeah.
from now, and like
Yeah.
it's incredibly difficult to do.
Yeah. So it's like, I mean, God knows I know that with the video. So I was very dead wrong on that. Although I said never to short because shorting doesn't work. That's a whole different thing. But the point is that, so if you can't control it's in our DNA that we need to have a sense of control, right? So you can't control the cycle you're in. You can't control the cards you're dealt. You choose to play the game. What can you control? your damn health.
Mm.
So sometimes the only way to salvation is to suffer and control what you can control in that suffering, right? And that, candidly, I mean, I have zero problem saying this. You know, and I'm very public about this. I launched my mutual fund day of QE3, risk on, risk off, at the start of the purest risk on cycle since the mid-90s. Okay. Yeah, a couple good years here and there, nothing really spectacular. I'm on the road. I'm killing myself to try to build a name, and I know the research, I know the studies. I also know that QE3 is distorted things, but I think it's going to end soon. I think it's going to end soon. I think it's going to end soon. It doesn't. It doesn't. It doesn't. 2020 comes along. My mutual fund's up 72%. I suddenly raised $350 million single handedly. I'm like, after all these years of grinding, I made it. I hit the escape velocity. I'm not going down again. This is my moment.
Overnight success story.
Overnight success after like 10 years, right?
Yeah.
And again, it's you know, it's not based on my opinion. It's rules based, right? It's like I just built the strategy, and the strategy took care of itself. And then it all gets ripped away from me. Fastest rate high cycle in history. No credit spread blowout. No flight to safety trade. Whipsaw, 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 whipsaw. You try to go small caps, doesn't work. You try to go emerging markets, doesn't work. So, of course, what happened? I ended up eating a lot. They call it comfort food for a reason, right? And I think with hindsight, I was probably myself going through some form of high functioning depression. How could I not? I thought I made it. It's like the whole 15 minutes of fame thing, right? And I'm not Kathy Wood. I didn't hold it, right?
Yeah.
So, right. So it's like, and anybody that's in this business will have a story like that at some point. Maybe mine was more extreme than others, right? So it got to a point where it's like I can't control it. I can't control the cycle, and that's the reason why I keep saying there's no gurus, only cycles.
Yeah.
Right? There's no gurus, only cycles. So what can I control? I control my health, right? And I still am optimistic on my strategies. It's like after all this, if you know, I'm still here. I know I have the audience to turn it up when it's there.
Yeah.
I know the tail event's out there. I hope it's this year, not because I want to see people lose money, because I never said the tail event would mean stocks would stay down, but it's the reset you need to right the hell of 2022, which I'm still dealing with the ghosts of, where stocks and treasuries did terrible, where avoiding a drawdown in stocks by being in treasuries was worse than being in the drawdown for stocks.
Yeah.
Something I've been thinking about lately is, assume that you're kind of allocating to managers or, even sort of picking your own strategies. But and we could agree, like, there's sort of like the strength of the swimmer, like how good is the manager at executing their process, doing what they say they're going to do, sticking to their knitting, and you being comfortable with how they execute that. And some are better or worse at swimmers. And then there's the like, which ocean did you get into to swim? And the tides are out of your control. They're, maybe going for you or against you. And they can be, I think we all are sort of one of the takeaways is that the tides have been really strong the last 10 years, maybe stronger than normal, and all kind of going in one direction. So who takes the responsibility for the decision of which ocean to get into? Is that at the allocator? Is that, who said like, okay, I picked you as I thought you were a good swimmer, but, it turns out that wasn't a great place to be swimming? Or is it on the manager and it's, like the thinking of the allocator is a little bit more or less nuanced and is just like, well, you're not making me money, so I need to fire you. And I think it's sort of a little bit under discussed in the industry about.
No, I agree with you. No, there's no question it's the allocator. But the allocator is dealing with the same problem that the swimmer is dealing with, which is how long is that tide going to push against you? Right? I mean, we're all dealing with the same problem. Nobody can tell what tomorrow brings. Full stop. Whether you're the allocator or the PM of the strategy. So now, having said that, the macro will always overwhelm the micro. And I always go back to macro helps you thrive, micro helps you survive. Right, in terms of the individual effort, is what it helps you get through a nasty macro. But the macro is still going to dictate 90s. But it's just like the old asset allocation studies, right? By Ibbotson and all these around, 100% of variability is based on asset allocation, not the individual positions, right? Or whatever the stat was. So yeah, I think you're right. It's not talk about the industry, but the industry also is designed in such a way that everybody's trying to do CYA. So I chose you, and I chose you at the top of your fund. You suck, fund manager. And the fund manager will come back and say, well, I didn't tell you to buy at the top of the fund.
The
Nasty
performance looked
business.
best then.
Yeah, nasty business, man. Then people don't appreciate you unless you're in the industry. It's a nasty business when you think through it.
I mean, it gives me a little bit of sympathy for guys like Ray Dalio or some of the other guys who say what you really want is 15 uncorrelated strategies
Yeah, exactly
and
right.
don't
Yeah,
worry
risk
about it.
parity.
Right. Yeah. But to get
One
to
of
that
them's going to
point,
work.
you have to have significant resources. So if you're going to be an entrepreneur, that goes back to large versus small, right? Large guys can do it. Small guys, good luck.
Yeah, I think you could probably, I think Meb does something like that where he's trying to aggregate up
Yeah, the
various different,
Trinity
Right,
Fund, I
right,
think he
right.
calls it.
yeah.
Yeah.
I don't know how that's gone. I haven't looked at it, but
Jason Buck as well kind of runs a
I can ask Meb. He's a client.
version of that.
Yeah.
yeah,
Yeah.
yeah. He's just down the road here from
Yeah.
me. Yeah, I've struggled with it a little bit too. I think that since 2012, there's been a clear cycle to growth and to large, which historically hasn't been the way that you want to invest because in the data that we have, depending on where you look, but it's pretty clear that small and value has outperformed. But it's to the point now where I think Cliff Asness has said that small might be broken to the
Yeah.
extent that it ever worked, might be broken as a factor.
It sounds like this time is different.
And then the value guys would say that there's two value camps, right? There's the value camp that's a little bit more compoundery, growthy, and they've done very well. And the deep value end, which is where I swim, hasn't done that well.
Yeah.
So it's not clear that, they would say, the compounder guys would say, well, that was obvious. It's too easy to screen for that end of the market. So maybe that is secular.
Yeah.
It's not cyclical.
Yeah, no one uses price to book anymore. That's the
Yeah.
right.
But as Cliff pointed out, the reason that worked better was because value did so badly. And so because it was a
Yeah,
less good value factor, it did
exactly.
better than all the others.
No one uses price to book, but everybody uses my calendar link, unfortunately. And I've got another meeting coming up in a few minutes.
Yeah, we're coming up on time. You want to let people know how they can get in contact with you or
Yeah, and
get in touch?
usually it's just screaming out loud, and you're probably gonna hear me because I'm on X at Lead Lag Report, Instagram, YouTube, with my own podcast, Lead Lag Live, which I've had you on also.
Yeah, it was great. I enjoyed it.
And yes, the Substack, leadlagreport.substack.com. You know, I am hopeful that these news announcements I'm going to have to come out with in the next couple of months will go well received. That I finally time funds at the right point in the cycle. We'll see. Because
Just
clearly,
takes one. You just got to get one.
I isn't that sad? It's just like no amount of effort matters. It's just about the luck of the launch. Uh,
You
yeah.
got to give Kathy Wood credit for holding on to the assets
Oh,
that she has
100%. Oh,
after she
yeah,
got
100%.
smoked.
100%. God, I mean, masterful.
It
People
was a
don't understand how hard that is.
good message. I don't know
Yeah.
what it was, like good messaging.
Yeah, I think it's fair. No, but at Lead Lag Report is typically where the handles are on most platforms. Not Telegram. Apparently, there's a lot of people. I've been told that like you've made it when you have scam artists that are imitating you. So apparently, there's several people on Telegram that are pretending to be me. It's not me. Right. But anyway, yes, I appreciate the invite.
Well, good stuff. Thanks, Michael. It's been a pleasure having you. Folks, we'll be back next week. Same bat time, same bat channel. We'll see everybody then.